Right now, as we watch the tape live on this Tuesday morning, November 25th, 2025, Rivian Automotive Inc., ticker symbol RIVN, is trading at exactly $15.27. We are seeing a modest move to the upside, currently green by 10 cents or roughly 0.66% on the session. The stock opened at $15.13, dipped briefly to $14.89 in the opening flush, and has since clawed its way back, hovering in a tight consolidation channel just above the $15.20 mark. If you are just glancing at the percentage change, you might think this is a non-event day. You might see a stock that is just treading water in a choppy market. But that is the trap. That is the surface-level noise designed to bore the retail trader into submission. The expectation on the street, the narrative you will hear from the skeptics in the headlines, is that Rivian is stuck in no man's land. They will tell you that EV demand is softening, that the competition from legacy auto is intensifying, and that Rivian is still just a cash-burning machine waiting for its next capital raise. The expectation is that this is a company fighting for survival, desperately trying to bridge the gap to its R2 launch in 2026. They look at the negative earnings per share and write it off as another profitless tech stock that had its moment during the pandemic bubble and is now slowly fading into irrelevance. However, the reality, the deep, fundamental reality that is currently being priced in by institutional accumulators is radically different. What we are witnessing at $15 isn't stagnation. It is a coiled spring. The reality is that Rivian has just effectively graduated from struggling automaker to Tier 1 technology provider. The market is completely underestimating the significance of the RV Tech joint venture with Volkswagen. This isn't just a partnership, it is a validation of Rivian's entire existence. While the bears focus on how many trucks they sold last month, the bulls know that Rivian is quietly becoming the operating system for the entire Volkswagen Group, a company that sells 10 million cars a year. We are not just looking at a car company anymore, we are looking at a software licensing juggernaut in the making. Let's dig into the immediate price action we are seeing today. The stock is respecting the $15 level as a massive psychological support. We saw a test of $14.89 earlier, and the bid support was instant. This tells us that the smart money has drawn a line in the sand. Whenever RIVN dips below 15, the algorithms trigger buy orders. Why? Because the risk-reward profile at this valuation has shifted dramatically after the Q3 2025 earnings report we just digested. We saw revenue hit $1.56 billion, beating estimates. But the real headline, the number that changes everything, is the positive gross profit of $24 million. Think about that for a second. The expectation was that Rivian would continue to lose money on every vehicle for another year. The reality is that they just turned the corner on a consolidated basis. This is the Tesla moment that investors have been waiting for, the moment when the unit economics finally flip. They achieved this not by selling more cars than expected, but by ruthlessly cutting costs and optimizing their production lines in Normal, Illinois. They stripped out cost from the R1 platform, renegotiated supplier contracts, and improved manufacturing efficiency. The fact that they posted a positive gross profit before the massive volume ramp of the R2 tells you that the operating leverage in this business is real. When you look at SoFi Invest or your Robinhood stock trading dashboard, you might see the negative EPS and get scared. But sophisticated investors using interactive brokers trading platforms are looking at the trend of the cost of goods sold, COGS. It is plummeting. Rivian is becoming efficient, and in the manufacturing world, efficiency is the precursor to profitability. The bears argued that Rivian would never make money on the R1T or R1S because they were too complex and expensive to build. The Q3 numbers just destroyed that thesis. They proved that they can engineer their way to positive margins even on low-volume, high-price vehicles. Now let's talk about the RV Tech joint venture, because this is the catalyst that warrants a much higher multiple than what we're seeing today. Volkswagen didn't just give Rivian $5 billion out of charity. They did it because their own software division, Cariad, was failing. They looked at the entire automotive landscape and realized that Rivian had built the best zonal architecture in the world. This is the nervous system of the car. It controls everything from the battery management to the infotainment. By licensing this to Volkswagen, Rivian has effectively created a zero-margin cost revenue stream. Every time Volkswagen sells a Scout, an Audi, or a Porsche that uses this architecture, Rivian benefits. This transforms the business model from pure hardware, low margin, high capital intensity, to hardware plus software licensing, high margin, scalable. The market is still pricing RIVN as a pure hardware play. As the first vehicles from this JV hit the winter testing phase in early 2026, we expect the market to wake up to this software-as-a-service valuation component. I want to pause here and challenge you to think about the long-term picture. Comment below. Do you think Rivian will eventually stop making cars and just become a software supplier for other OEMs, or will they become a major global automaker themselves? I'm curious to see if you view them as the next Apple, hardware plus software, or the next Android, software only. Let's shift gears to the product pipeline, specifically the R2. The R2 is the Model Y for Rivian. It is the mass market vehicle that takes them from 50,000 units a year to 500,000. The expectation is that the launch will be plagued by delays, just like the R1 was. The reality is that Rivian has learned its lessons. They delayed the Georgia plant to focus on launching the R2 in Illinois first. This was a brilliant capital allocation move. It saved them over $2 billion in immediate capital expenditures and allows them to use their existing, trained workforce to ramp up the new vehicle. The prototypes we have seen and the R3 and R3X surprises show that the demand is there. The R3X, in particular, broke the internet when it was revealed. It taps into a nostalgia for hot hatches, but with a futuristic rally car vibe. This design language sets them apart. While Tesla stock bulls will argue the Cybertruck is the future, the Cybertruck is polarizing. The Rivian R2 and R3 are universally acclaimed for their design. In the automotive world, design is still king. We also have to discuss the cash runway. This has been the biggest bear case. Rivian will run out of money. That was the chant in 2024. But look at the balance sheet now. They exited Q3 2025 with over $7 billion in cash and equivalents. With the Volkswagen capital injection coming in tranches, their runway now extends comfortably through the R2 launch. They do not need to raise capital in the public markets anytime soon. This removes the dilution overhang that has suppressed the stock price for so long. When you take bankruptcy off the table, the floor on the stock price rises significantly. That is why we're seeing such strong support at $15. The bankruptcy trade is dead. Now we're in the execution trade. If you are looking for investment help or considering online investing strategies, you have to look at where the institutional money is flowing. We are seeing a quiet rotation. Funds that hold Tesla stock and Nvidia stock are starting to diversify into Rivian as a catch-up trade. Fidelity Investments and Fidelity Mutual Funds have been steady holders, but we are seeing increased activity from active managers who are betting on the 2026 breakout. The institutional ownership is steadily climbing, which reduces the float available for short sellers. And speaking of shorts, the short interest is still hovering around 12%. This isn't GameStop levels, but it's high enough to fuel a squeeze if we get a major news catalyst, like an early start to R2 production or another major OEM partnership. Let's look at the competitive landscape. Tesla is the king, no doubt, but Tesla is also aging. The Model Y is ubiquitous. It's the new Toyota Camry. For a certain demographic of coastal, affluent buyers, the Model Y is no longer cool. It is the default. Rivian is the alternative. It is the adventure brand. It signals something different. This brand equity is intangible, but incredibly valuable. Then look at Lucid. Lucid makes a great car, but they are selling sedans in an SUV world, and their cash burn is terrifying compared to Rivian. Fisker is gone. The herd has been culled. Rivian is the last man standing of the EV IPO class of 2021. Being the survivor in a brutal industry consolidation often yields massive returns for the winners. Now, I want to address the macro environment. We are in late 2025. Interest rates have stabilized and are inching down. This is crucial for Rivian because almost no one buys an $80,000 truck with cash. They finance it. As rates come down, monthly payments drop, and the addressable market for the R1S and R1T expands. Furthermore, the leasing program has been a huge success. Rivian's lease deals have been incredibly competitive, acting as a